Almost everyone is looking at the wrong thing right now, because in the last 72 hours, 4 signals just lined up that historically lead to one outcome: massive money printing. The same setup appeared once before, and it triggered $4.5 trillion from the Federal Reserve. Now it's happening again. The architect of the 2008 bailout is warning of a system-level break. The Treasury is stepping in to support its own market, and while investors are trying to get out, the next Fed chair is preparing to flip policy with political pressure to cut rates immediately. And Bitcoin? It's already moving ahead of all of it, climbing while traders are paying up to 12% just to stay short. That's not speculation, that's a signal, and almost nobody is reading it correctly. And if you follow it carefully, you are going to understand exactly why the next 12 months could be unlike anything you have seen in your investing lifetime. Stay with me. Nothing you hear on the wealth continuum is financial advice. This is education, analysis, and informed perspective. Always do your own research before making any investment decision. If you are new here, welcome to the Wealth Continuum. This channel is about understanding money at a deeper level than the headlines give you. Hit that subscribe button before we go any further, because what I am going to walk you through today took a serious amount of digging to put together, and this is exactly the kind of breakdown we do here every single week. Now, let us get into it. I want to give you a framework, a sequence, 5 links in a chain that are already moving. And the terrifying part is that most people watching the markets right now can only see 1 or 2 of them at a time. We are going to see all 5. And once you see all 5, you cannot unsee it. Here is the chain: oil, inflation, real rates, the Federal Reserve, Bitcoin. Write that down if you need to, because I'm going to come back to it 4 times in this video. Every single link is already in motion. 3 of the 5 are locked in. The 4th one, the Federal Reserve, just had its biggest obstacle removed in the last 2 weeks. And the 5th, Bitcoin. Bitcoin does not wait for the rest of the chain to finish. It moves before the others even realize what is happening. Let me walk you through each one. Think about what you paid to fill your tank this week. Actually, do not think about it. It will just make you upset. Here is the data as of today, Monday the 27th of April, 2026. WTI crude oil is trading at $96.49 a barrel. That is up more than 2% in today's session alone, and it is 55.5% higher than it was exactly 1 year ago. The reason is sitting in the middle of the Persian Gulf. The Iran conflict, now in its 9th week, has effectively sealed the Strait of Hormuz. Tehran submitted a new proposal over the weekend through Pakistani mediators about potentially reopening the strait. But as of this morning, President Trump has instructed his envoys to suspend discussions. Iranian President Pezeshkian has made clear that Tehran will not negotiate under what he calls imposed pressure. So the strait stays closed, and markets are reacting exactly the way you would expect them to. But here's the part that does not get reported, because it is not dramatic enough for television. The damage to your cost of living is already done whether the strait reopens tomorrow or not. Gasoline prices are a leading indicator for headline inflation. They lead by roughly 6 months what crude oil does today, your grocery bill and your heating bill feel in the summer and autumn. You cannot run crude oil 55% higher in 12 months and have nothing happen downstream. Every trucked item, every manufactured good, every service that depends on energy, all of it reprices. This is not theory, this is physics. The last time crude oil spiked with this kind of persistence was 1979. That episode sent core inflation to 13.5%. The Federal Reserve Chair at the time, Paul Volcker, had to crush it with interest rates near 20%. The stock market gave back a decade of progress. Nobody is saying that is the exact playbook this time, but the underlying forces, they're the same. Link 1, oil, locked in. So oil is pushing prices higher. You feel that at the pump. You feel it in your grocery cart. You're going to feel it harder in July, August, September. But here's the critical move in this chain that almost nobody is talking about clearly. Year-over-year consumer price inflation is about to cross above the yield on the 3-month Treasury bill. Now let me explain why that matters, because most of the financial content you see online will just throw this statistic at you without explaining the real-world consequence. When cash yields more than inflation, sitting in a money market account makes sense. Your purchasing power is preserved or slightly growing. You do not need to take risk. You do not need to buy anything scarce. You just park your dollars and they do not rot. That is exactly why the Federal Reserve was able to hold rates high through all of 2023, 2024, and into 2025. Because millions of people were perfectly happy sitting in Treasury bills and money market funds, earning real positive returns. But when inflation crosses above cash yields, when your money market account is paying you less than inflation is costing you, the entire calculation inverts. Every single day you stay in cash, you are losing ground in real terms. Your dollars are silently shrinking. And when that happens, capital has to move. It has to find something that holds its value. Historically, when this regime takes hold, when short-term real rates go negative, the assets that benefit most are the ones with genuine scarcity: gold, real estate, and in the era we are now living in, Bitcoin. The numbers when this regime has happened historically for Bitcoin are staggering. Annualized returns above 200% during the specific windows when CPI runs above 3-month Treasury bill yields while the Fed is on hold or easing. Not one time. Every time this combination has appeared. And here is the thing you need to sit with for a moment. We are weeks away from entering exactly that window again. Does that mean Bitcoin is going to double in 12 months? I am not making that claim. What I am saying is that the macro environment setting up right now has historically been the single most powerful tailwind Bitcoin has ever had. Stay with me, because the Fed is where this gets truly remarkable. Kevin Warsh, if you are not familiar with that name, you need to be, because he is about to become arguably the most powerful person in global financial markets. President Trump nominated Warsh to replace Jerome Powell as Federal Reserve Chair. Warsh is not a new face at the central bank. He served on the Board of Governors from 2006 through 2011. He was literally in the room when the first quantitative easing program launched in 2008. He voted for it. He voted for the second round in 2010. And then he spent the next 15 years becoming one of the loudest critics of what he had participated in, calling quantitative easing a policy that transfers wealth upward rather than downward. So when Trump picked this man, the market assumed he would be a hawk, someone who would tighten, not loosen, rein in the money supply, bring fiscal discipline back to the central bank. And then Warsh walked into his Senate confirmation hearing and said something that sounded tough on its surface, that the Fed needed to reduce its balance sheet and that the current period of inflation reflects past policy errors. But read between the lines, because his argument, the argument he is already building publicly, is that keeping rates too high right now is the new mistake. That is not a hawkish argument. That is the setup for rate cuts, dressed up as corrective policy. And then he said something on financial television that sounded like a throwaway line, but is actually the entire strategy. He argued that artificial intelligence is going to be strongly deflationary over the coming years, that we are at the beginning of a structural decline in prices driven by technology productivity. Think about what that argument does. If you believe AI is going to push prices down over time, then you have a permission slip to cut rates today despite rising inflation. You can tell the public that any current price pressure is temporary, that the technology will absorb it. You can deploy the word transitory all over again. And if you remember what happened the last time that word was used aggressively to dismiss inflation concerns, well, you know how that story ends. The argument is convenient. It is internally coherent. And it is almost certainly wrong in the way that matters most, because central banks can print money, but they cannot print copper. They cannot print diesel or electricity. They cannot print the physical infrastructure required to run artificial intelligence at scale. AI creates deflation in software and knowledge work. It creates inflation in power, in semiconductors, in data center construction, in the physical inputs the economy needs to support the digital transformation. So you get creative destruction in some labor markets and scarcity inflation everywhere that matters to running the real economy. But that nuance does not fit on a Senate confirmation slide. So the alibi gets built, the cover story gets constructed, and the printer gets warmed up. Does this concern you? Does it frustrate you? Tell me in the comments. Because I want to know how many people watching this have already been feeling this in their daily lives and just could not name what was happening. Now I want to show you something that should have been front page news in every financial publication. It was not. And the fact that it was not tells you something about how these things work. The United States Treasury has been conducting debt buyback operations. The program was announced years ago and originally framed as routine technical management, starting at $2 billion per week, scaling to $4 billion per week by 2025. What nobody was supposed to notice is what has happened since. These operations are now running at $15 billion in a single session. That is a 7.5-fold increase in under 18 months. Programs do not scale like that when they are temporary plumbing adjustments. Programs scale like that when something has broken. And here is the detail that should send a chill through anyone who understands bond markets. When the Treasury ran its most recent $15 billion buyback, existing Treasury holders responded by offering $40 billion worth of bonds for sale, 3 times the intended purchase size. Some of those bonds were offered at well below face value, meaning holders were willing to take an immediate loss just to exit the position. When investors accept losses to get out of something, they are not managing a position. They are fleeing a risk. This is the United States Treasury market, the supposed safest asset in the world. And then Hank Paulson went on television. Paulson was the 74th Treasury Secretary of the United States. He personally wrote the $700 billion TARP bailout during the 2008 financial crisis. He is not a hedge fund manager trying to talk up a trade. He is one of a handful of people on Earth who truly understands how the U.S. financial architecture works under stress. And he said publicly that the country needs an emergency break-the-glass plan ready for when the Treasury market hits the wall. He said it will be vicious when it comes. Now, think about that for a moment. The man who wrote the playbook for the last financial crisis is telling you publicly that a new crisis is coming and that Washington is not ready for it. Why is the Treasury market under this pressure? Two converging forces. First, foreign central banks have been net sellers of U.S. Treasuries for 3 consecutive years. China has reduced its holdings from over $1.3 trillion to under $800 billion. Japan has been a net seller for 2 years. Foreign official ownership of the Treasury market has drifted from 34% a decade ago to around 24% today. When the United States froze $300 billion in Russian central bank reserves in 2022 in response to the Ukraine invasion, every other central bank on Earth received the same message simultaneously. Your reserves held in U.S. Treasuries are not unconditionally yours. They come with political strings, and quietly, systematically, those central banks started rotating out. Second, the buyers who stepped in to replace them are not stable buyers. They are hedge funds running highly leveraged positions, financed overnight in the repo market. The Federal Reserve's own economists published a paper showing these funds are holding roughly $1.85 trillion in treasuries, a number that is a full $1 trillion larger than it was in 2022. And critically, these positions are estimated to exceed the levels that existed in March of 2020, when this exact type of trade broke down and forced the Fed to intervene with emergency purchases to prevent a full market seizure. So the buyer of last resort, when the basis trade eventually unwinds, when the repo market seizes, when the next failed Treasury auction happens, is going to be the Federal Reserve. There's no one else in the room with a balance sheet large enough to absorb it. And Kevin Warsh was specifically selected because he will cut rates and print when that moment arrives. That is the pipeline, not a theory, a mathematical inevitability written in the structure of the debt. And here is the number that makes it undeniable. The United States government currently pays over $1 trillion per year in interest on its national debt. The Congressional Budget Office projects that number more than doubles to $2.1 trillion by 2036. The interest payments this year already exceed the defense budget, and roughly 53 cents of every new dollar the Treasury borrows goes toward paying interest on existing debt. The Fed cutting rates is not a policy preference. It is arithmetic. Yields have to come down, or the interest line swallows the entire federal budget. Does that number surprise you? Because it surprised me the first time I truly sat with it. Here is where everything comes together, and here is why the wealth continuum exists, to connect these dots before the mainstream catches up. Bitcoin bottomed at roughly $60,000 on the 28th of February, as markets cratered in response to the opening of U.S. strikes on Iran. As of this morning, the 27th of April, it is trading around $78,000. That is a recovery of roughly 29% in under 2 months, through the largest oil supply disruption in recorded history, through a crisis that has shut down a global waterway. Through relentless negative commentary from mainstream financial media, the bears have been positioned against this rally in numbers that are extraordinary. Perpetual futures funding rates have run negative, meaning shorts are paying longs to maintain their positions, for over 40 consecutive days. Bears have been paying 6 to 12% annualized just to hold their short bets against Bitcoin. Put option premiums have been running 10 to 20% above call premiums, meaning the market has been pricing in a crash that has not come. The shorts are dominant, the sentiment is negative, and Bitcoin just keeps grinding higher. Why? Because Bitcoin is not trading sentiment right now. Bitcoin is trading liquidity. It is trading the forward expectation of monetary expansion. It is the only asset on Earth that is 24/7 globally liquid, genuinely scarce, politically neutral, and large enough, at a market cap now around $1.3 trillion, to absorb institutional flows at scale. When the printers start warming up, Bitcoin does not wait for the announcement. It moves in anticipation. It has done this 7 times since 2020, across 7 separate geopolitical crises: the US-Iran confrontation of 2020, the COVID shock, Russia's invasion of Ukraine, the US banking crisis of 2023, the yen carry trade unwind of 2024, Liberation Day, and the current Iran conflict. Bitcoin has posted positive 60-day returns every single time. 7 out of 7. The S&P 500 was positive 6 of 7. Gold was positive 5 of 7. Bitcoin was perfect. That is not a coincidence. That is a structural feature of what this asset actually is. And before any of you say, yes, but Bitcoin is just correlated to tech stocks, I want to address that directly. That correlation broke down last year. Bitcoin is no longer tracking the NASDAQ. It is rediscovering its relationship with global liquidity. And it is doing it at the exact moment that global liquidity is about to expand faster than it has since 2008. Stay with me here. because these two data points are going to change the way you think about what is happening right now. First, every single time in Bitcoin's history that it has recovered 30% from a cycle low, it has never gone back below that low. 6 for 6 across 13 years of price history. The cycle low this time was approximately $60,000 in late February. A 30% recovery from that level puts the confirmation threshold at just under $79,700. Bitcoin briefly touched $79,000 this morning before pulling back slightly. We are sitting directly at the doorstep of a level that, historically, has marked the point of no return. If Bitcoin closes and holds above that level, history says the $60,000 floor never gets revisited. Second, Bitcoin's 200-day exponential moving average has compounded at 30 to 35% annually for over a decade. The lowest it has ever drifted is 29%. It has never gone negative, not in the crashes of 2018, not in the crash of 2022, not in any of the brutal cycles this asset has been through. You know what that means? It means Bitcoin is no longer behaving like a cyclical speculative asset. It is behaving like a monetary asset with structural upward drift, one that is now sitting in the most bullish macro regime it has ever encountered. Now, let me ask you something directly. Given everything we have just walked through, the oil shock, the inflation math, the Treasury market stress, the Fed chair who has already been told to cut, the foreign central bank rotation out of dollars, does the idea of Bitcoin as a hedge start making more sense to you, or are you still looking for a reason to dismiss it? There are no wrong answers here. Tell me where your head is in the comments. That is genuinely why this section of the video exists. I want to know where you are in your thinking. I saved this part for near the end because on its own it sounds remarkable enough that some people would tune out early if they heard it first. But now that you have the full context, I want you to hear this clearly. Admiral Samuel Paparo, a 4-star Navy admiral and commander of U.S. Indo-Pacific Command, the largest geographic combatant command in the U.S. military, testified before the Senate Armed Services Committee and publicly stated that Bitcoin is a valuable computer science tool with relevance to power projection. He said it has important applications for cybersecurity and that anything supporting all instruments of national power for the United States is to the good. That is a sitting 4-star admiral responsible for American military posture across the entire Pacific, talking about Bitcoin in a congressional hearing. And then Treasury Secretary Scott Bessent told Congress in the same week that U.S. leadership in Bitcoin secures the primacy of the dollar as the world reserve currency. Let me say that one more time, slowly. U.S. leadership in Bitcoin secures the primacy of the dollar as the world reserve currency. The Treasury Secretary of the United States is framing Bitcoin as a tool of American financial and geopolitical dominance, not as a threat to the dollar, but as a reinforcement of it. The top of the U.S. national security apparatus, the Treasury Department. Both pointing at Bitcoin as a strategic asset in the competition with China, with Russia, and with every nation that has been quietly rotating out of U.S. treasuries for the past 3 years. When the people managing the empire start talking about something in those terms, you do not brush it aside. Think about what this means, not for a week from now, for the arc of the next 5 to 10 years. And ask yourself this honestly. If the United States government views Bitcoin as a tool of financial power projection, what does that suggest about the direction of institutional adoption, regulatory clarity, and strategic accumulation over the next decade? That is the question I want you to carry with you when this video ends. Let me tie every thread together. Oil is at $96 a barrel. The Strait of Hormuz has been functionally closed for 9 weeks. The International Energy Agency has called this the largest energy supply shock on record. The inflation you're going to feel in the summer is already baked in at the gas pump today. The incoming Federal Reserve Chair has publicly signaled that keeping rates high is the new mistake, and has constructed an AI deflation alibi that gives him cover to cut rates and expand the money supply even as prices run hot. The Treasury market is showing structural cracks. Hank Paulson, the man who wrote the 2008 bailout, is publicly calling for an emergency plan, warning that the wall, when it hits, will be vicious. Foreign central banks have been reducing their U.S. Treasury holdings for 3 straight years while buying record amounts of gold. The buyers who replaced them are leveraged hedge funds whose positions now exceed the levels that triggered a market seizure in 2020. Interest on the national debt now exceeds $1 trillion per year, more than the defense budget, and that number is projected to more than double over the next 10 years. Bitcoin has recovered nearly 30% from its February cycle low. It is sitting at the precise historical level where, if it closes above it, 6 cycles of data say the low never comes back. It is decoupling from technology stocks and rediscovering its relationship with global liquidity at the exact moment that global liquidity is about to expand at the fastest pace since 2008. The U.S. militaries and the Treasury Department are both on record describing Bitcoin as a strategic asset. The chain has 4 links locked in. The 5th is moving in front of you right now in real time. Here is what I want to ask you, and I genuinely want you to think about this before you answer. If the Federal Reserve is eventually forced off the sidelines, not by choice, but by arithmetic, and the response is not $700 billion like in 2008, but multiples of that, what happens to the purchasing power of cash? What happens to assets with genuine scarcity? And what happens to the one asset on Earth that was specifically designed to exist outside of that system? You do not have to agree with the conclusion, but the question deserves a real answer. Drop your thoughts below. Before we get to the close, I want to hear from you on 3 things specifically. 1, are you currently holding any Bitcoin? And if so, has your conviction changed after what we just walked through? 2, when Paulson says the wall is coming and it will be vicious, do you believe him? Or do you think this is fear-mongering? 3, the AI deflation argument that Warsh is building, do you buy it? Because if he is right, the playbook looks very different than if he is wrong. Tell me which side of that debate you land on. And listen, if this video gave you a new lens for looking at what is happening in the world right now, share it. Not for me. Share it because the person you share it with is probably already feeling the weight of higher prices and a system that does not feel as stable as it used to. And they deserve to understand why. Sharing this video costs you literally nothing, but it could fundamentally change how someone you care about thinks about the next decade of their financial life. Like, share, and comment. It takes 10 seconds, and it puts this content in front of people who need it. That is genuinely the most powerful thing you can do to help this channel grow. Here is where we land. The biggest monetary expansion since 2008 is not an announcement waiting to happen. It is a mathematical process that is already underway. The Treasury is already buying back its own debt at 7.5 times the pace it promised 2 years ago. The incoming Fed chair was selected precisely because he will cut when told to. The interest line is devouring the federal budget in real time. And Bitcoin, the only asset on Earth that is simultaneously scarce, apolitical, borderless, and liquid, is already front-running all of it. Whether you are a skeptic, a believer, or somewhere in between, the fundamental question of our financial moment is this. What stores value in a world where the largest issuer of the world's reserve currency has structurally committed to expanding that supply without limit when the pressure becomes unbearable? That question has an answer, and the wealth continuum exists to help you think through it clearly, without noise, without sensationalism, and without selling you something. If you're new here and this is the first video you have watched, this is what we do. We take the complexity out of macroeconomics and financial markets, and we give you frameworks that actually help you make better decisions. Subscribe now if you have not yet. And hit the bell so you do not miss the next one, because the Fed meeting this week is going to generate a significant amount of commentary, most of it misleading, and I want to make sure you have the right filter before you hear any of it. Stay curious, stay skeptical, and stay building. I will see you in the next one. The Wealth Continuum, understanding money at the level it actually operates.